5 ways to suffer massive losses in trading options and how to avoid it. This is a very important topic because from my experience, when I first started trading options, I was introduced about this strategy called the cover call. It was very interesting because cover call, what it means is this: I can be able to own stocks and be able to every month collect premium, like renting out my stocks and they collecting premium on that for that. And it's actually a very popular strategy. As long as the market continue to go up, right, staggered or sideways, you're okay. And it was very popular 20 years ago, and I was actually interested. But as I go through in detail after that, it wasn't that popular. There are also other obstacles into it. So I decided actually to find out more how to do it. So let me go through the 5 ways that you can suffer massive losses in trading options. And the first way is that you learn too many strategy. I was checking around the internet. There was a page that says about 28 different trading strategy. I think maybe more. What are the 28 trading strategy? I think it's just too many. Let me give an example. Things like they call the Christmas tree spread call options strategy, or the diagonal spread with put strategy, or the diagonal spread with call strategy, or this the iron butterfly with put option strategy. It's so complicated. Now, I'm not saying this does not work. As a newbie or a person who just started trading options, I suggest what you do is learn a simple way that you can understand and master that way. Don't master 28 strategy all at one time. Do one at a time until you really get to know exactly how to do it. Okay? Option trading there's so many different ways of doing, but just apply one way and get started moving to it. Is that cool? So what is the one way to get started doing it? Number one is select one instrument that you can be able to monitor. Don't look at so many stocks. That people have a tendency to look at, okay, these technology stocks or the health stocks, or actually is biotech or retail or industry. No, select one. So I highly recommend that, for example, you start with something that's simple, a basket of stocks like index, like S&P 500, like SPDR. Start with one, and then actually do the option on one. Very simple. Do option, whether it's a call option to make money on the upside as the stock price goes up, or the put option as the stock price comes down to make money. Okay, study one. Okay, do something simple. Understand what it's about. Is that cool? So that's number one. Don't do a 28 strategy all at one time. Do one first. Cool? To avoid that. That's number one. Number two, don't know how options are being priced. People have no clue. They only think about options are where you can make money when stock price goes up, you buy the call option. Or stock price goes down, you buy the put option. Have you ever even noticed that sometimes stock price goes up and your call option doesn't go up in value? Stock price go up by $10. Your option price may go up by 5 cents, 10 cents, 50 cents, or $1. Why is that so? Because options has a way of being priced. So you need to know that there are 4 major things in pricing of option. 4 major things, okay? What are the 4 major things that make up the component in pricing option? Number one is about the stock price. Generally, higher the stock price, the more expensive it becomes. Fair, right? If you buy IBM stocks or Apple, maybe $100 or $200, it's cheaper in the option price versus, for example, you buy Amazon, $2,000-$3,000, right? Different, yeah? So one thing is about the stock price. Number two is about the strike price. Strike price is how close your price with the stock price. And there's other technology things that says about at the money, out of money, or in the money. If you buy the one that is out of the money, meaning the strike price is further away from the stock price and doesn't give you the advantage out of the money, it's cost cheaper. If you buy in the money, means you have the advantage when it moves in your favor, it costs you more. So it's about the strike price. So stock price is number one, strike price number two. Third element, very important, that a lot of people didn't miss out. And I learned this from my mentor, it's called volatility. Volatility has 2 types. One type of volatility is the past movement relating to the stock price. Another type of volatility is the implied volatility relating to the implied future price of the option. Okay, and these are where if people are expecting that particular stocks to move a lot, then actually the higher implied volatility means the higher premium price that comes in. So your particular stocks may have been factored in with a higher volatility that even if it goes in your favor, your option does not move a lot. Is that cool? Okay, so third element is look at volatility. The fourth element in the pricing of the option is called time decay. The longer the period, the more you pay. The shorter period, the less you pay. It's just like insurance, like buying insurance. Is that cool? So 4 important matters that you would have to factor in about the pricing option. The stock price, the strike price, volatility, implied volatility, and the fourth one is time decay. Cool? How long that period? There's other elements, but maybe not so crucial, but 4 important elements. Cool? That's the second thing. The third thing is that when people trade options, they are guessing which direction the market is going. So they say, okay, I guess that the market is going up, so I buy the call option. I guess the market coming down, buy the put option. What if you don't have to guess these things? Because guessing may be 50-50, right? What if you don't have to guess? What if you make money whether it's up or down? Would that be good, right? So options allows you to do that by buying both the call and put option together. But you must remember one fundamental fact to make it work. A simple fundamental fact, take off the complexity out of it. I want to share with you this tip. These tips are very important. If you pay for the call option, let's say is $1.50, and you pay for the put option, let's say it is $2. Of course, you are trading non-directional. You don't care whether it's up or down, you want to make money, right? So the combined $1.50 for your call option plus the $2 for your put option is a combined total value of $3.50. Now, how do you know if you buy, for example, Spider, you're going to make money? It is when Spider are going to move over whatever period of time that you have actually contractual, that it must move higher than $3.50. So if Spider move up by $5, you'll make money. If Spider move down by $5, you'll make money. But if Spider, for example, that's the thing that you're trading, is less than $3.50 or less, then you lose money. It's as simple as that. I know there's other factors that's involved, but this is the very basic one. Don't forget this thing. If you understand this thing immediately, you don't need other option calculator to work this thing out. It's a very simple fact. Whatever cost you are paying for the call and put, make sure that the movement is higher than both of them, of your particular stocks. Is that cool? Okay, so that's number 3. Number 4, why people lose money massively in trading option is because they bet the farm. When I say bet the farm means that they find that they may be making money the first time, making money the second time, maybe 5-6 times in a row, 7 times in a row, 8 times in a row. They think that they got the key to the kingdom in trading options, right? So what they do, number 9, take all the profit, put into one trade. Maybe you're going to mortgage the house, put into one trade. That's called betting the farm. Bad idea. Because why? Even any strategy that people share with you, I never lost money before. Every year should make money. 100% going your way. What happened? This year is the first time that you lose money. Could it be possible? Anything on the first time? Or people say, okay, there's an 80% chance of winning, 20% chance of losing, right? So it is possible that whatever method that has been done, don't bet the farm. So how much do you so don't avoid losing everything. So what do? You want to make sure that your risk, you know, what is your risk appetite? Different person have different risk appetite. Some are more aggressive, that if they lose everything, they say, no problem, I can fund their account, okay? Somebody said, this is my survival money, I can't afford to lose. So their risk appetite are different. Yeah? Obviously, if it's your survival money, don't trade, okay? Don't gamble. I don't say gamble, don't go and risk that kind of money if it's so important to you. So when you trade, that kind of money that you allocate, and if you happen to lose it all, okay, you got to prepare for it. But I'm not asking to lose it all, but just to be able to manage the risk then what's your risk appetite? So let's say, for example, if your account is say 10,000 to start with. Number one rule is don't use everything. At any one point in time, use 50% or less. 50% less at any one point in time. So don't you overbet. That's number one rule. The number two rule is this. If you happen to lose at any point in time, you don't lose more than 10% of the entire capital. Let's say it's 10,000 and any one trade and any one position, you don't lose more than 10%, for example. Okay. So which means that you already have to be so bad that you lose 10 times in a row to lose everything. Okay, that will happen. Also, the other rule that I highly recommend you to observe is this. If you have don't look at too many open positions. 1, 2, or 3 maximum. It depends on you. I can't focus more than 2 or 3, right? If you have too many open positions, it's difficult to focus. And also the other thing very important is this. If you happen to have the same strategy and you find that you have 2 consecutive losses in the same strategy that works well, then don't do live trading on the third one. Do paper trading and see how it goes. Win 2 times on paper trade, then you go back to live. That is a way to protect yourself. Is that cool? So you don't have consecutive losses and better fun. Very important? Okay, so that's number 4. Number 5, very, very critical. It is simple, it is very basic, but it's very easy to get wrong. And the very easy to get wrong is that people are executing the trade wrongly. Wrong trade execution. Why would people execute the trade wrongly? Why? Because in option trading, or even buying stocks, there are 2 types of prices. There's an ask price and there's a bid price. Ask price is what you buy. Bid price is when you sell. The ask price is higher than the bid price. So sometimes what people does is when they start off, instead of buying that particular option, they press the other button and they're selling. Okay, can go through. So buying and selling are 2 different things. If you are buying on your option, you have no obligation because that's the maximum money that you're willing to invest. And if it goes wrong, that's a maximum loss. But if you hit the button says sell first, you have financial obligation. Selling option means you're collecting premium, means you have obligations to be met. Okay, so big difference. So some people can mix up between buying and selling. That's number 1. And number 2, people could buy, let's say 10 contracts, and they're not careful, they sell more than 10. Okay, and then maybe let's say they sell 12. So there are 2 contracts that are oversold, which have financial obligation. So how to avoid those sort of things? Focus number 1 is practice first. Practice with paper trading for a period of time to understand how it moves so that you have the confidence to do it. That's number 1. Number 2, after you have practiced, when you're trading live, start with smaller amounts so that you don't get too excited for the emotional element. So that you concentrate properly. And the other element is to avoid these things is like focus. Take the trade daily on a specific time so that actually you have the habit to do it. And then make sure that you don't get distracted or other things, watch television while you're doing those things. Trading option takes us maybe 5 to 10 minutes when you take the trade on a daily basis. I got some of my members who have actually taken like 10-15 minutes a week. So it doesn't take a lot of time. I do it 5 to 10 minutes at any point in time, get it done. So focus on doing that period of time. Don't get distracted and do this thing properly. Cool? I hope these 5 ways to suffer losses, you know what is it and how to avoid it. Is that cool? So let me repeat. Number 1 is learning too many strategies, like 28 of them. Don't do so many. Okay? Focus on 1. Number 2, know how option are priced. There are 4 elements on that. And so that you can be able to discover the way and do it properly. That's number 2. Number 3, people guess which direction the market is going. Don't do it. Do non-directional trade, combine both of them. But make sure that the move is more than what you pay for call and put option. Cool? Number 4, don't bet the farm, but know what is your risk appetite so they can manage the risk. And number 5, people trade wrongly, execute the trade wrongly. What you want to do is to make sure that you practice it well and do this thing properly. Is that cool? Go for it. I hope you love this session and be able to continue. Let us know. Subscribe to our YouTube channel and also to our Facebook group if you choose to. Go for it. Thank you.